Hello, everyone. My name is Maroon. I'm the VP of Operations at Farhat Accounting Lectures, and I'm more than happy to guide you through a sales transactions cutoff test exercise. In the exercise, I'm going to present the facts in a narrative form without any exhibits. Now, I know that on the CPA exam simulations, you might come across exhibits, and I'd understand that a lot of students feel intimidated by simulations that have many exhibits. But I want to assure you, you don't have to be. We're here to equip you with all the knowledge that you need to handle those simulations confidently. All you need to do is to focus on understanding what the examiners are trying to test, what is the call of the question in the simulation, and how to extract the required information from the exhibits in order to answer the question effectively. Let's assume, for example, in a simulation that you are the auditor of Electrotech Industries, and your objective is to evaluate the company's compliance with the cutoff assertion as it relates to sales transactions. And you are provided with 3 exhibits. You have to read the title of these exhibits. So we have bill of lading, sales invoices, sales by customer detail report. In order to solve the simulation, you have to keep in mind that the cutoff assertion ensures that transactions and events are recorded in the correct accounting period. So how do we know that sales transactions are recorded in the correct accounting period? What is the information that I need to extract from the bill of lading in order to test the cutoff assertion? So I'm going to open the exhibit. I have here the information about the shipper, which is the company where we are auditing, Electrotech Industries, and the customer is Gadget World. We don't care about information such as the total weight, for example, here, carrier name, vehicle number. What I care about are the shipping terms. And the shipping terms here are FOB destination, meaning that I need to know the arrival date of these goods, when they were delivered to the customer in order to determine when the transaction needs to be recorded. If the shipping terms were FOB shipping point, then I would look at the departure date or the date when the goods were loaded in the dock. And here in this case, the departure date is December 31st, 2023. And the estimated arrival date is January 5, 2024. So here, I don't care about the departure date. I care about the arrival date because the shipping terms are FOB destination. And I know for sure that this transaction should not be recorded in 2023 because the goods are not going to be delivered in 2023. Next, I'm going to look at the sales invoice to see if the sales invoice was issued in 2023. In this case, it would be a misstatement. So I look at the issuance date and I look at the delivery date. So the delivery date is January 5, 2024. And the invoice date is correct. It is issued in 2024. So here I don't have any issue. The customer is Gadget World. The goods are the same goods. And I have the total 9,720. This is the information that I need. Then I'm gonna see the sales by customer detail report, looking at the date of the transaction. The date of the transaction here is December 31st, 2023, which is wrong. The company recorded the journal entry in the wrong period. It overstated its sales transactions, meaning that it overstated its net income by 9,720. It overstated its accounts receivable also by the same amount, because this transaction should be recorded in 2024, since the goods arrived in 2024 and not in 2023. So if the question was, is there any cutoff misstatement? Yes, there is a cutoff misstatement, and it is an overstatement of 9,720. And then you can answer the question related to this transaction. Now, the examiners may also provide you with other exhibits related to other transactions, or with memos or emails where you have to extract the information from these documents. The number of exhibits doesn't matter. As long as you have an in-depth understanding of the topics through the information we're providing you, you're going to be just fine. Let's go ahead and get started with the exercise.
Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Greenfield Electronics Inc. sells electronic components to manufacturers. The company policy requires that a pre-numbered shipping document be issued at each sale. Now, this is a very important internal control for the cutoff and completeness assertions. Let's assume the company is starting the pre-numbering of shipping documents from 1. If 4 is missing, that indicates that the sales transactions are incomplete because of this missing shipping document, and that will lead the company to make an investigation and try to determine why this shipping document is missing, and maybe identifying the missing shipping document and recording the omitted sales transaction. At the time of pickup or shipment, the shipping clerk writes the date on the shipping document. The last shipment made in the fiscal year ending December 31st, 2023 was recorded on document 3124. The auditor will write down the shipping document number and will make sure that any sales invoices related to shipping documents after this number will not be recorded in the year 2023 because they were shipped after the year 2023. Shipments are billed in the order that the billing clerk receives the shipping documents. For late December and early January, shipping documents are billed on sales invoices as follows. Here we are provided with the shipping document number and the related sales invoice number. As you notice here, the shipping documents are pre-numbered. They are sequentially pre-numbered. But if we look at the sales invoices, they are not sequentially pre-numbered, which is not helpful with controlling the issuance of sales invoices. They should be sequentially pre-numbered. Remember that the shipping document 3124 is the last shipping document in 2023. Therefore, the sales invoices related to shipping documents 3125, 26, and 27, they should not be recorded in 2023. So sales invoices 6548, 6549, and 6550 should not be recorded in the year 2023. The December and January sales journals have the following information included. We have the sales journal of December 2023 and the sales journal of 2024. Now remember what we said, that 6549 invoice and 6548, they should be recorded in 2024 because the shipping documents related to these two invoices, 6548 and 6549, they were issued in 2024, regardless of whether the shipping terms were FOB shipping point or FOB destination. These two invoices need to be recorded in 2024 because the shipping date is after 2023, and definitely they're going to be delivered in 2024, not in 2023. So these are overstatements of sales. Do we have any understatements of sales? We look at the sales recorded in 2024. We have the invoice 6542, which relates to a shipping document issued in 2023. Same thing for 6545. Those two may be understatements of sales, but we need to look at the shipping terms, FOB shipping point or FOB destination, and when these goods were delivered, if the shipping terms are FOB destination. The question is, assuming that the shipping terms for all of the above transactions were FOB shipping point. FOB shipping point means that these two invoices were shipped in 2023. They should not be recorded in 2024, but they should be recorded in 2023. So they are understatements of sales and accounts receivable. Which sales invoices, if any, are recorded in the wrong accounting period? So we have 4 invoices recorded in the wrong accounting period. Prepare adjusting entries to correct the financial statements for the year ended December 31st, 2023, assuming that the company uses a periodic inventory system. With a periodic inventory system, identifying misstatements is more difficult than with the perpetual inventory system, because with the perpetual inventory system, we can know the balance of the inventory at each date. And we can compare the physical inventory count with the book inventory balance, and any differences would be investigated. However, with the periodic inventory system, we count the goods at the end of the period, and we assume that any goods that are not there have been sold. So there is no way to control the inventory and try to investigate whether there have been any unrecorded sales or any damaged goods. Let's start with the solution, and specifically with the understatements. We have the invoice 6542 and 6545 were not recorded in 2023. They were recorded in January 2024. So they affect the completeness assertion. Whenever we have a cutoff misstatement, it's going to affect either the completeness or the occurrence assertion. So understatements affect the completeness, means that some transactions have been omitted and the records are not complete. And for overstatements, the occurrence assertion is affected because we have sales invoices that should have been recorded in January 2024 and were recorded in December 2023. And those two invoices are 6548 and 6549. They relate to shipping documents that were issued after year end, after the shipping document number 3124. This is the last shipping document in 2023. So here we have an issue with the occurrence of sales transactions. These two transactions did not occur in 2023. Next, we're going to look at the table showing the misstatements. We're going to compute the net effect of these misstatements. Is it an overstatement or an understatement? Invoice number 6542 understated the sales by 2,641. Invoice number 6545 understated the sales by 206. Invoice number 6548 overstated the sales by 1720. Sales invoice number 6549 overstated the sales by 5,214. If we add these four together, we're going to have a net overstatement. So this is a net overstatement because the overstatements are more than the understatements. We have a net overstatement of 4,087. The adjusting journal entry is a debit to sales revenue to reduce the overstated sales revenue, and a credit to accounts receivable to reduce the overstated accounts receivable. Here we have an issue with the occurrence of sales revenue and the existence of these accounts receivable. They shouldn't have been recorded in this period. They don't exist, those accounts receivable, in this period. They belong to the year 2024. Next, we're going to look at question number 3. Assuming that the shipping terms for Greenfield Electronics were FOB destination instead of FOB shipping point, we're assuming here that the shipping terms are FOB destination and that none of the goods sold in December 2023 were actually delivered to the buyers within the same year. This means that all of these sales invoices should have been recorded in 2024 and not in 2023, because they have been delivered in 2024 and they are FOB destination. Here, we don't care when the goods were shipped, but rather when the goods were delivered. And they were delivered in 2024. We need to identify the resulting misstatements in the sales journal for December 2023. And based on this scenario, provide the necessary adjusting journal entries. So here, if the shipping documents were FOB destination and none of the goods were delivered in 2023, it means that the ownership of the goods did not transfer to the buyer until 2024. Therefore, all sales recorded in December 2023 would be considered premature and should be recorded in January 2024. Here we only have an overstatement issue because we have sales that we have been recorded in 2023 that should have been recorded in 2024. They have overstated the sales and the accounts receivable during 2023. So what should we do? All the sales invoices recorded in December 2023 are misstated and should be recorded in January 2024. We have to add all these sales invoices that were recorded in December 2023 and belong to the year 2024. Their total is 8,432. And we have to make a journal entry in order to reduce the amount of the sales, overstated sales revenue, and to reduce the overstated accounts receivable by 8,432. What should you do now? You should go to Farhat Lectures, look for additional resources to help you with your CPA exam or your audit exam. Thank you for watching and happy studying.